gentlemen, this is Amit Pabari, founder and managing director of CR Forex. On a last week video, we discussed that 80 to 70 to 80 to 90 is going to act as a strong resistance for the pair, and there is 80 to 85% probability that the pair is going to move towards 80 to 20 and 82, and the pair has moved in the same direction. Now the big question is, where is rupee heading? Whether it is going back towards 83 level or it is going to appreciate and move towards 81.5 level. In this presentation, we are going to discuss that. Before discussing about the future, let us go back to history. On May 8, we had given a presentation saying that dollar index is going to take support at 100 level and it is going to move towards 105 kind of a level. And one of my clients remembered that and discussed, saying that Amit Bhai has said the dollar index is going to move towards 105 kind of level. Dollar index moved exactly the same manner. It moved towards 104.80 kind of a level. Because of all of this reason, from last 2 months, the view was very straightforward. 81.80, 81.90 acting as a support, 80 to 70 is going to act as a resistance. But something has changed in last 1 week. Let us discuss that, which is going to give us a bigger view for the dollar rupee in coming days. Now let us see what has changed. The first important change has happened in dollar index. If you see the chart, dollar index has closed below 100 level on a weekly basis. If it closes below 100 on a monthly basis, it is giving you a clear-cut indication that dollar index is going to move towards 95 kind of a level. If that happens, all emerging market currencies and rupee is going to get stronger. Now, because of falling dollar index, if you see the chart, most of the Asian currencies and emerging market currencies have got stronger. And if you see, rupee on a relative basis have not become that stronger. It is indicating that rupee is also going to get stronger in coming days. The third important aspect for Indian rupee is that we have seen FII have continuously investing in Indian equity market. Close to 14 billion has come in Indian equity market in last 6 to 7 months. The reason why money is still expected to come in Indian equity market is because of two reasons. First, stronger fundamental and positive real yield. Positive real yield means that interest rate in the economy is more than the inflation. Now let us discuss outlook for rupee. The way dollar index has broken the key support area of 100 levels, it indicates that there is a major trend reversal in dollar index. Rupee has a positive correlation with dollar index. If dollar index has changed the trend, it indicates that there is 90 to 95% probability that rupee is not going to get weaker beyond 82.70 to 83 kind of a level till March 2024. And probably the pair is likely to move towards 81.50, 81 and 80.50 kind of a level in next 6 to 8 months. We have discussed the bigger view on a shorter frame of time. Rupee is going to face tough resistance near 82.22 and 82.47 kind of a level. Any upticks toward those levels should be used by exporters to increase their hedge ratio. Now let us discuss strategy for thin margin exporters. On last week video, we discussed that thin margin exporters should cover 100% on a back-to-back basis, and for the coming week, we have found that a lot of thin margin exporters have taken costing close to 82 level, suggesting the same policy, cover 100% on a back-to-back basis. Any uptick towards 82.20 to 82.40 should be used as a selling opportunity. If any thin margin exporter wants to wait, they should keep a strict stop loss of 81.90. If 81.90 is broken, they should simply go and cover. Now let us discuss strategy for thick margin exporters like textile exporters or engineering exporter. As the major trend in DXY has changed, it is going to create pressure on rupee as well. So ideal strategy for any thick margin exporter is that on every uptick they should increase their hedge ratio. So for the coming days, thick margin exporters should follow the following strategy. Most of the thick margin exporters must have booked forward close to 82.60 to 82.70. It is obvious that thick margin exporter will be tempted to pre-utilize those forward. Why? Because of the regency effect. 8180 पे यूज करते थे, 8270 में बुक करते हैं, लेकिन इस बार 82 के आसपास में हमको फॉरवर्ड यूज नहीं करना है. Why? Because dollar index has broken the key support level of 100 and it is going to move towards lower level. So idea क्या है? Idea ये है any uptick towards 8220 to 8240 should be used as an opportunity by thick margin exporters to increase their hedge ratio. अभी hedge ratio कितना रखना है? Ideally they should keep a hedge ratio between 75% to 80% on a confirm order basis. Now let us discuss strategy for importers. When rupee was trading close to 8180 to 8190 at the end of June, we suggested importers that they should ideally cover 1 month import between those area, and most of them have bought and they must have got benefited also as the pair moved towards 80 to 70. But those who have missed, they should continuously wait for lower levels of 8180 to 8190 to increase their import cover ratio. The idea is that they should not cover aggressively, they should only cover 10 to 15 days import. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे. Thank you.